Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Dana Udumulla. Dana is an investment manager with Madison Trust Company, and she brings a wealth of experience in the alternative investment industry. With her expertise, Dana has helped numerous clients achieve their investment goals through self-directed IRAs. As a certified IRA service professional, Dana specializes in IRAs and alternative investments such as real estate, private equities, and many more. In her role at Madison Trust Company, she oversees the team and assists clients with their investments while ensuring compliance with the IRS regulations. Dana is dedicated to empowering investors to gain control of their retirement planning to achieve their financial goals through securing their financial future. So, Dana, welcome to The Wealth Flow.
Thank you so much for having me today, Keith.
Yes, I can't wait to dive in. As we were talking a little bit ahead of the show, you are our first guest that really specializes in this. And so very excited to ask several questions. But really, before we get there, if we could start with your background, kind of where you grew up and what eventually led you to this profession.
Fantastic. My favorite subject, self-directed IRAs, but a little bit about me. So originally, I'm from Sri Lanka. Not a lot of people know where that is. It's a little island off the Indian Ocean. So I'm an islander. I came here about 7 years ago to, follow my dreams, the American dream, get an education and see where my life leads. It's funny. I wanted to be a corporate lawyer, and that's what I first went to school for. I took a finance class, fell in love with stocks and bonds, and then pursued finance. Got a master's in financial analysis, worked at a few boutique investment firms, and then somehow life happened and I came across alternative investments in Madison Trust and fell in love even more. So my first love was gone. Then I found alternative investments and there was no turning back. And it's been a beautiful almost 5 years now.
Yeah, that's great. That's fantastic. And maybe if we can dive a little bit into, the IRAs, and maybe we can start with the foundation, though. A lot of our audience, they've got their 401k. Many of them may have self-directed IRAs, but if we could just maybe give a background on what distinguishes your product from some of the others that are out there, and then we can dive into some more information on them.
Absolutely. Now, there's a common misconception when it comes to self-directed IRA, because all the big players out there, and we're talking about Charles Schwab, Fidelity, Merrill Lynch, they all have some sort of a self-directed IRA. However, that is not the same as what Madison Trust offers when it comes to self-directed IRA. Now, with these big players, your IRA, which is an individual retirement account, very different from 401ks, can only invest into stocks and bonds. But Madison Trust, we take that a little beyond. So with a Madison Trust self-directed IRA, you can invest into anything other than stocks and bonds. So we are really focusing on everything alternative. So we're talking about actual real estate, like tangible property. We're talking about crowdfunding, private startups, private equity, promissory notes, one of my favorite, Arabian racehorses, boat slips, marinas. So everything beyond what your normal, big players invest in, we can actually invest in those alternative investments other than stocks and bonds. So in my world, what I always tell my clients is that consider Madison Trust an IRA plus, because with us, you're able to diversify your portfolio. There is no 60 to 40. Now here, if there is something you're really passionate about, like in the past few years, Keith, everyone wants to get into real estate, right? But perhaps the IRA you have right now won't let you get into real estate. But an IRA with Madison Trust, you're absolutely able to purchase a piece of property under the name of your IRA and put that in your retirement portfolio. No hassle at all.
Can you roll over on that note, if you have an IRA with a Charles Schwab or whoever, and can you roll that over to be controlled by Madison Trust? And tell us a little bit about maybe how that would work.
Absolutely. And the quick answer is yes. You can absolutely roll over, whether it's a 401k, 403b, any type of qualified retirement plan to an IRA, because we are still an IRA just focusing on alternative investments. A lot of our clients who got into this space didn't know that was possible. So when they realized that, I might have a 401k with a previous employer that's really doing nothing right now, getting hit with the stock market. What else can I do? That's when they found out Madison Trust. Now, a few things to point who have qualified retirement plans. Sometimes if you're still working with that employer, because most qualified retirement plans are employer-sponsored plans, right? You might not be able to roll the full plan over because you're still employed. So the best way to find it out is talk to your plan administrator. Ask them, hey, I'm considering rolling a portion of my 401k to an IRA, self-directed IRA. Am I able to do so? If so, what percentage of my 401k can I move? Because a lot of people are not aware that 401ks, qualified retirement plans can be rolled over because they're under the assumption, hey, if I'm still employed with this employer, I can't do anything. This has to stay here. Or I don't have anywhere else to put this money, so I'd rather keep it in the stock market. And that's what I aim to do. I want to increase the educational awareness out there. There's a lot of things we can do if your 401k is just sitting there.
Yeah, no, that makes sense. And I'll have to check in on mine as well and see, because as we were talking before the show, I've got one now, but and I'd love to roll it into some real estate or something. So I'll have to ask. I'll have to just check that out. Now, when you roll over an existing IRA into, say, with your company, Madison Trust, is there any kind of a penalty or fee, or as long as it stays in, the tax deferment stage or whatever? Yeah, maybe you can explain that a little bit better than I can ask the question.
So an IRA, so even the self-directed IRAs, they're still under that tax advantage umbrella. So when the 401k gets rolled over, even though it's going from one qualified plan to, like, say, a self-directed IRA at Madison Trust, you're still within that tax advantage umbrella. So technically, there are no penalties or consequences because you're not really taking money out from your retirement plan to yourself personally. Typically, in this field, with anything, whether it's a qualified retirement plan or IRA, only if you take the money out personally, we consider that a distribution. That's when you might have some tax consequences or implications. Here, it really wouldn't happen because it's going from one qualified retirement plan to another IRA. So technically, it's still under the tax advantage umbrella. There are certain tax forms. For instance, the 401k might have a 1099-R when you're rolling it over. And then the IRA might have a 5498. They basically, now I'm getting a little too technical, not to scare anyone off, but they basically just balance each other out, and it's all good.
Okay. No, that's good to know. And, we talked a little bit about investing in real estate. And this is, you asked me how much I know about self-directed IRAs before the show, and I'll just say it for the audience as well. What I do know is that you cannot invest in your own deals, right? You got to invest in other people's real estate deals. But tell us a little bit about maybe some of those restrictions, and why somebody would want to invest maybe in real estate within an IRA.
Absolutely. Now, it's easier to talk about the things you can't invest with a self-directed IRA rather than the things you can, because the things you can, it's really endless. Now, the common things you cannot invest, and this is IRS regulations, it's collectibles, life insurance, and S corporations. Other than that, IRS also has certain regulations, and that's what you were just mentioning right now, Keith. Investing with disqualified individuals. So you, Keith, as the IRA account holder, is considered disqualified to your own IRA. That means you can't use your IRA to invest into your business. That would be considered prohibited transaction. And you are absolutely right. So clients who use self-directed IRAs typically tend to invest in others' deals. So let's take real estate, for example. There's two kinds of real estate deal. One is some of our clients love to have actual property. So a beach house, I have also heard skiing resorts, multifamily, the people love that. Houses in golf clubs, all that fun stuff. We like to call them vacation properties. So people would like to have vacation properties through their IRA. So the IRA actually holds the property. And the reason people like to have actual property within an IRA is because of the tax advantage. Now imagine having a property within your IRA that appreciates in value with time. And depending on the type of IRA you have, it's either tax deferred or completely tax free. Why wouldn't you want your vacation property to be bought through your IRA at that point, right?
Yeah, for sure.
And exactly. And since it's a vacation property, people tend to rent it out. There might be property management companies renting this property out, and all the rental income incurred from this vacation property now comes back into your IRA again, tax deferred or tax free. So you're able to collect all this rental income and reinvest into something else.
Wow, and so these are properties, and maybe I missed it, but these are vacation properties. So let me just say, like a house at a ski resort or a condo at a ski resort, and but they're not owned necessarily by. Are they owned by somebody else, and it's just the income that's coming in, or how does that piece of it work? When I think of vacation rental, I think of one I can go and use.
So now, of course, that's where everyone has a little bit of a restriction there. So let's say, Keith, you have Madison Trust IRA, okay?
Yeah.
You just bought a beach property, okay? A beach vacation property using your Madison Trust IRA. So the property is not under your personal name. The property or the deed is under Madison Trust Company, FBO, your name, your account number, because your IRA is owning it on your behalf. So your IRA is the full owner of that whole property and land. Now, because you are a disqualified individual, you cannot use that vacation property within your IRA. Now, that's where the pros and cons of everything, right? That being said, you're able to rent it out to anyone, and that rental income is able to accumulate within your IRA, and you're able to reinvest. Not just vacation property, Keith. I have dealt with a lot of individuals. They've done multifamily, apartment complexes, commercial properties, you name it, anything in the real estate industry. In the last few years, we have seen it. Now, that's actually owning full property. Some of my other clients prefer more passive investing, which means they get into deals called private placement or private offerings, where companies would be raising money to invest into these large multi-million-dollar apartment complex projects or, real estate development projects. So what they would do is my clients would set up self-directed IRAs, invest into these private offerings, and then that's it. They sit back and just watch that investment grow. So let's say at the end of whether it's a year, 2 or 3, they'll get their cash back plus profits in return, and They did absolutely nothing. They just set up an account, invested into the deal, and then just watched it grow.
Yeah, that's great. That's incredible. And we talk quite a bit on this show about that, and a lot of our guests actually have deals and different things that folks have become familiar with. But that's really interesting. That's very interesting, though, that you can use it also to purchase a property. It just has to be in the trust or in the IRA, Madison Trust name, I guess. Very, very cool. And so, are there any restrictions going back to that maybe a little bit as far as you managing that, or does it need to be managed by like a third party if for instance, it was going to be a short-term rental?
So, great question, because like I said, the IRA account holder is a disqualified individual to the IRA itself. That means the IRA account holder personally should keep an arm's length from the IRA investment. Something I always like to say is IRA account holders shouldn't go to these vacation properties and even like change a light bulb or mow the lawn. Everything needs to be done from a third party perspective so that you're not mingling your personal versus your IRA investments. Now, what a lot of people, they do is they hire third party property management companies so that they will manage the entire property, take care of everything, and just the proceeds or the profits from the property come back to the IRA. Other than that, for some of our clients that really love freedom, they want to be more hands-on. It's their retirement. They want to be in control. We have something called a checkbook control model. Basically, it's an IRA key. Within the IRA, we assist the clients in setting up something called an IRA LLC. It's a limited liability company that is able to function under an IRA. So basically, you have a little LLC within your IRA. There's a checkbook account, a checking account associated with it. And the IRA account holder is the non-compensated manager. So you set up your IRA. Within it, there's an LLC. We'll fund the LLC with your 401k rollover. Once it's funded, you as the manager of the LLC, you have freedom to go and invest as you please. At that point, you're able to order or instruct or whatever you would like to do with your rental property because you're the manager. So you have the right to do so. You can renovate it. You can hire people to renovate it. You can manage the income and expenses all using the LLC checking account. Now that is perfect for someone who's looking for more control rather than an arm's length transaction.
Yeah. No, that's neat. Wow, you're blowing my mind today. There's a lot of things out there I didn't realize you could do.
I have that effect on people this year.
Yeah, I'd say so. On that, if you do own a property, we have a short-term rental, and one of the nice things was getting the bonus depreciation on it at the beginning of this past year. But I assume if it's underneath Madison Trust, you're not going to recognize that particular benefit that you would if it was outside because you're not technically the owner, right?
Correct. Now, depreciation write-offs come up quite often, and I feel like sometimes we tend to forget depreciation benefits are only short-term, right? It's at the present value. When you use an IRA to invest in real estate, yes, you forego those ability to write off depreciation. That being said, in the long run, you're going to have far more tax benefits than the depreciation you're writing off at that time. Because with property, and this has been so obvious in the last few years with the real estate market booming, right? Clients purchase properties for $100,000 and right now it's worth about $300,000. And all that, either tax deferred or tax free, that appreciation. Not to mention the rental income they might have earned from it, again, tax free and tax deferred. So my question really is, if you had a choice between either purchasing a property through your taxable personal income or purchasing a property through a self-directed IRA where you can take advantage of these tax benefits, what would you do? Would you prefer to get taxed every single time and your income tax every single time? Or would you prefer to let go of that depreciation write-off for the time being to really just reap in all those benefits years down the road?
Yeah, no, that's a great point. And, and if you do take it up front, then oftentimes that kind of puts you in a position where if you end up needing to sell it down the road, or maybe you change your mind, now all of a sudden, you have the recapture of the depreciation when it comes time to sell. So I could see that, being obviously it cuts both ways there for sure. So
Now, don't forget also capital gains tax. Just because you sell it, like say you purchased it personal, right? When you sell it, you still have to pay all taxes on your sale proceeds. Now, consider you're selling it through an IRA. The profits come back into your IRA, which is again under that tax advantage umbrella, and you're able to reinvest without having those tax implications.
Yeah, that's great. Very interesting. And what was I was going to ask also? One of the things I've heard on self-directed IRAs is, being aware of something that the IRS calls UBIT. Can you maybe explain what that is and just what people need to be aware of when they're investing in real estate through their self-directed IRA with respect to UBIT?
Fantastic. So UBIT actually stands for unrelated business income tax. Typically, any investment in an IRA is considered passive investing. So UBIT doesn't come into play. But the minute it turns from passive to active income, that's when UBIT comes into play. For instance, consider an active business, and my favorite example is a pizza shop, right? In a pizza shop, I'm here in New Jersey. We love a pizza here, so
right,
pizza shop it is. So every single day you're having right expenses and money flowing in because it's an active business. If you were to have an active business like that within your IRA, you're going to incur UBIT because it's no longer passive. However, when it comes to real estate, having a vacation property where monthly you get rental income, that's considered passive, where you don't have those implications from UBIT. But let's say you start flipping houses, multiple houses a year. There's a chance you might have UBIT there because now no longer are you in that passive income. Your passive income just turned to active income. What I always like to say is Madison Trust is a passive custodian, so we can't really provide any financial, legal, or tax advice. I always recommend if you're looking at a deal that might incur UBIT or you're unsure, you should talk to your financial professional, a CPA, and a ERISA attorney just to take a look at the high-level overview of the investment structure to determine if you will have UBIT. Because if you do incur UBIT, you do have some extra filing, a little bit of extra paperwork that you will have to complete, give it to your IRA custodian and pay it using your IRA. But grand scheme of things, UBIT is not something we see often.
Okay. That's interesting. And I don't know a ton about it. I've just heard, people kind of advise on it. And so thought I would ask the question. So as long as...
I was going to say, I think it's because people hear the term UBIT and then immediately they're like, oh, wait a minute. If I do this, am I going to get UBIT? But like I said, it's far and few. You're not going to incur UBIT just because you get into a real estate deal. If the real estate deal is only incurring active income, at that point you will see it. But again, far and few.
Okay. So like a apartment deal, for instance, that you're just a limited partner investing through your self-directed IRA into it. Obviously they'll have distributions, but the distributions would go directly back into the IRA. And then at some point, the property would sell at the end. But as long as it was all kept within that, you wouldn't necessarily have any active income from it. Is that correct?
Typically, LPs, we don't see active income. Now, again, I say typically there might be those one-off instances where there is something else happening within the LP, like partnership that incurs it. But right. I always tell my clients, take a look at the investment documentation. Really do your due diligence, because at the end of the day, this is your retirement money and you don't want to just, oh, that looks like a great deal. Let me just put all of my money there. No, take some time, do some research, because that's really important.
Yeah, for sure. And so maybe outside of real estate, you mentioned some other things that you can invest in through the self-directed IRA. Can you maybe go talk about that a little bit more as well?
Of course. So some other really popular investments I've seen is precious metals. Anytime inflation goes up, I get those calls. Hey, how can I get into precious metals? That'll always be a constant, Keith. Everyone would always try to get into precious metals because hedge against inflation. Other than that, I've seen promissory notes. The IRA is lending to either individuals or companies. And especially recently with the high interest rates, a lot of people have shifted towards debt investments because they're starting to look very lucrative. Other than that, I also mentioned crowdfunding, startups. Have you heard of angel investors?
I have.
So imagine doing that same concept, but within your IRA. And with startups, of course, there's a chance, high risk, high reward, right? So either it's going to work out or it's not. But if it does work out, there's a chance your IRA is just the value of your IRA is going to skyrocket. We've seen stocks, we've seen debt, and of course the one-offs. Like I said, the one-offs being Arabian racehorses, marinas, Broadway shows, movies, royalties. My clients tend to get very creative, and I like it like that.
Yeah, that's neat. I didn't even realize you could invest in all of that through an IRA. It makes sense because they're investments for sure. You hear people investing in art and different things. So there's just a ton of stuff out there. So that's very neat. So if somebody, let's say there's an obvious scenario, right? If you had a prior employer and you had a 401k and, you've moved to a different job. So you're no longer, that money's maybe just sitting there. Maybe it's in, stocks, mutual funds, whatever it may be. And you want to roll it over. That to me is, I don't know if that's more common or not, but it seems like that would be a very common instance. However, I would assume that people have the ability to create one of these even if they don't have an existing one. So maybe they sell a property, they have a chunk of money that they want to put into kind of fund this IRA. Could you maybe talk a little bit about some of the options there?
Of course. So there's a few ways to fund an IRA. Now, of course, we just discussed one, which is rolling over from an existing qualified retirement plan to an IRA. You can also transfer from an existing IRA. So like say you have one at Charles Schwab or TD or somewhere there. You can transfer money from that IRA to a Madison Trust self-directed IRA as well. Other than that, you can contribute to your IRA. So every year, if you're 50 and under, you can contribute $6,500. And if you're 50 and older, you can contribute $7,500 to your IRA. So a lot of younger folks who might not have worked with an employee long enough to have a substantial, nest egg in your 401k, they actually start off by contributing. So that's their personal taxable income. They contribute to an IRA, whether it's a traditional or a Roth IRA. Now, something you just mentioned there, and I do want to make a point of clarification. If you have, let's say you have a property, Keith, and you sell that property, you cannot put the entire proceeds from that property into your IRA because of these limitations. You can put that $6,500 or $7,500. If not, the funds need to come from an existing retirement source like the 401k or that IRA. And that's another thing. Something you own personally, you cannot transfer it to your IRA. Everything you own personally needs to be kept very separate from your IRA's dealings.
Yeah. Makes sense. Okay. Yeah, that makes sense. I didn't think about the $6,500 limitation there. So that may be why it's so common to roll it over from another, but you certainly could set it up. And if, like you mentioned, if you're younger and you're kind of building it up, or just wanting to build something up that you can contribute to each year, that you have an opportunity to have a little bit more autonomy on what you want to invest in, then this would certainly be a good option for you.
Absolutely. And something that comes to my mind is a lot of younger folks. Remember the cryptocurrency craze in end of 2020, 2021?
Yes.
A lot of folks set up IRAs. They contributed to it and invested in crypto. And for those of who timed the crypto market right, they saw fantastic returns. But of course, crypto is very volatile. So sometimes it's down, sometimes you never know what's happening. But that was like one of those instances where younger folks who didn't have a lot of money in their 401ks, they still wanted to get into something, diversify. They contributed to their IRA and got into crypto.
Yeah, that's a good point. That, because I think of $6,500 and gosh, how long is that going to take to grow? But you talk about one of these investments like a crypto, like something that has the potential, angel investing has the potential to grow, just dramatically. Then you could build up that account here pretty quick. So
absolutely. And I know and you said yourself, you actually spoke with a lot of individuals who have private offerings that they're raising capital. Most of the time they require accredited investors to be in for those deals. But then, offerings that are either Reg A or Reg CF, you don't need to be an accredited investor. So you can start as low as $500. And still, that's something I always love to see when people are trying to diversify their portfolio with something rather than nothing at all.
Yeah, for sure. Yeah, I had a guess that where you can invest very little. Chris 70, who's got 70 investments, and they invest in notes. So good opportunity there to be able to put a smaller amount, but that can grow fairly quick. What are some other maybe advantages or things that folks should know about a self-directed IRA?
Well, with a self-directed IRA, I think the first advantage is, of course, diversifying. A lot of people that I speak to on a daily basis, they call me because they are tired of just watching their hard-earned money getting hit by the stock market. I spoke with a lovely lady the other day. She lost $70,000 this year. And that's a lot of money. That is a lot of money. And she was just telling me if she knew about self-directed IRAs before, she would have rolled over her funds in a heartbeat. So diversification is number one. Number two is take control. And listen, I myself have an IRA with stocks and bonds. I myself have an IRA with alternative investments. Why just stick to one thing, right? What's the famous saying in our industry, Keith? You never put your eggs in one basket. So you want to put it everywhere, but you also want to have control. So alternative investments are where you can invest into something you're passionate about. I had a client invest into brewery technology because he really, really loved breweries. Great. That's what you're passionate about. But also the fee structure. At Madison Trust, we like to make retirement affordable and accessible. So our fee structure is flat rated. So we charge an annual fee, charge quarterly, and nothing based off on portfolio value. So you can have an investment of $100,000, and that investment could actually mature and end up being $500,000. We are not charging based off on portfolio value. So our fees remain the same, and that's an advantage. There's no management fees on top of that. There's no 1%, 2%, 5%. It is what you see, which really gives that client that feeling like, you know what? I want to be more successful because my account growing doesn't mean I have to pay out more. I don't have to pay a lot more in fees. It's going to be the same overall. That being said, there's another side of self-directed IRAs I'd love to share with you. So we're talking about the individual, right? Where you might want to set up an account to invest in real estate. I'll expect your call after this session.
That's right.
Stay tuned. But the other side is I actually work with a lot of companies. So you spoke about Chris, who's doing notes, right? So I actually work with a lot of companies like that who are raising capital in this market. And I actually help them tap into their investors' retirement money. So they might already have investors that are using their taxable money to invest into these companies. Now imagine giving them the option of using their retirement money to invest into this company that they believe in. So on this side, I work with individuals who want to diversify their retirement. On the other side, I work with companies looking to raise capital for their deals and just being that platform to make it happen. Just this year alone, we have helped raise about $120 million in private equity.
Wow. Wow. That's great. Yeah, for sure. So you can be a partner as far as that goes as well. That's great. And then what about education? What do you do? I assume, maybe it's not you specifically, Donna, but a big piece of this is really just letting the public know about it, right? I mean, a lot of folks just don't realize the options. So what do you do, or what does your company do to kind of get that word out? Obviously, podcasts would be one, but
and I thank you for that, giving us that opportunity to educate everybody. But really, this year is the year that we are spearheading an educational initiative, because all this time we've grown organically, Madison Trust Company. But a huge part of the feedback I received with the individuals I work with, our companies, is that, Donna, where were you before? I wish I knew this or Madison Trust before. So this year we're doing a lot of educational initiatives. Our site, MadisonTrust.com, we have a huge resource center for anyone who's interested in learning about self-directed IRAs, what you should do, what you shouldn't do. Everything's available on our site. Other than that, Keith, we also do a lot of webinars and podcasts. Madison Trust, at least once a month, we host a webinar where we would bring experts in the industry to talk, or we will actually select certain topics that our clients want to discuss. They are live webinars, so clients can actually ask questions, or just anyone can attend and ask us questions, because we want to bring that awareness. Self-directed IRAs have been existent since 1975. But the truth is, nobody knew about it up until recently. It's only right now, with how volatile the economy is, everyone's trying to get into self-directed IRAs. And that is partly because of the educational component. Other than that, I really love this other feature we have. They're called account navigation. So basically, you don't need to have an account at Madison Trust, but you can call one of our CIXP trained experts to set up a time to go over the entire process of a self-directed IRA, but also ask them any questions. So I'm thinking of doing this. Can I do it? Oh, I can't do it. Okay, perfect. What can I do using my self-directed IRA accounts? What are the restrictions? All that, we are happy to provide that education at no cost, because education is very important.
Yeah, for sure. Yeah, I mean, you have to know what you're able to do, before you can make an educated decision on it. So that's great. I think that's important. You mentioned diversification a little bit ago, and I think that's important. If you do have somebody that has, a decent amount built up in a 401k or a IRA, and they want to roll it over to Madison Trust, they don't have to put all their eggs, like you said, in one basket as far as the next investment that they're going to invest in. That's one of the, complaints I have about, my current 401k is just there's a list of things that you can invest in, and it's pretty limited. There's not a lot. And so, but you have the ability to put, if you're an accredited investor and are investing in, real estate deals, you can choose something in self-storage, you can do multifamily, you have the option to kind of split up, a portion of your total into these various asset classes. So you're completely diversifying from that standpoint.
Absolutely. With a self-directed IRA, you can invest into anything you really please. And that's why we created that checkbook model. There are some clients, once they got a taste for self-directed IRAs, that was it. Now here they're out there investing in every deal that they think is lucrative. And then having that freedom of having your own LLC to be able to do it is amazing. Some clients don't even want the LLC. They just absolutely use their Madison Trust account to get into 15 different investments because they love it. But of course, I like being transparent with everybody. Before you get into this world, you want to sit down and do the research, because like we were discussing, this might not be the solution for everyone. If you're fresh out of college, you're just starting off your career, this might not be the time for you because you're still building out a little sizable amount in your 401k, right? But if you have multiple 401ks out there that are doing nothing from previous employers, I think it might be time to consolidate and consider a self-directed IRA. Take a look at those private deals, what's happening out there, and try to get into it. Because Keith, the everyday American doesn't have 100,000 in their checking account. However, they might have that amount in a 401k. And I have seen that happen multiple times.
Yeah, for sure. No, that's a great point. Yeah, it really does. It helps give you, it's funny. I was listening to an investor call on a development deal, and that was one of the big things. They said, it's this amount of an investment, right, as your initial investment, but it can come from a 401k. It can come from an IRA. And so there's a way to be able to pull it. And a lot of times that we built these things up and we just assume they have to stay there. But it's great to hear that there's some other options out there. What about reporting? And, I say reporting. What kind of communication, is the, owner of the IRA, able to see? Like if I go in on mine, we do ours with Charles Schwab. And so I can go in and I can bring it up. I don't do it right now because it's a little painful, but you can go in and you can kind of see, okay, here's how I'm tracking, are there some features and some things, from a visibility standpoint that you can see how everything is growing?
Absolutely. So with Madison Trust, when you have a Madison Trust account, you have the ability to create an online account. And within that online account, you can just keep track of your entire portfolio, right? Now, that being said, these alternative investments are very different from, stocks. They are not fluctuating as stocks does. So with your Charles Schwab account, today might be a bad day, but tomorrow might be a good day, right? And vice versa. With alternative investments, say like you invest $50,000 in a private deal, you're not going to see that go up and down. So what we typically have is either the company, the private offering will provide us yearly or quarterly or biannually statements so that we'll update the client's asset value, or the client themselves can update the asset value per that investment company's instructions. So you're not going to see a lot of activity with your alternative investment unless something is happening with the investment company. But majority of the time, once it's invested, the clients are able to see an overall picture of the account. And if there is anything, of course, they can give Madison Trust a call and just let us know what's going on.
Yeah, makes sense. Yeah, good point as far as it just not fluctuating near as much, short of, like a Bitcoin or something like we were talking about. But for most real estate deals, it's going to be a very, a lot of that's at the tail end of the hold period. And so.
Exactly. The only things, like you said, I would think would fluctuate is, of course, crypto all the time, precious metals, every day the spot value changes. So that you might see a little difference in your account. Everything else otherwise remains as is until the time of maturity. And then once the investment cycle has run, at that time, that's when you really get your proceeds back into your Madison Trust account. Okay.
Is there anything that's required since money's in the 401k or the IRA? Is there anything from a reporting standpoint that's needed on your yearly taxes?
Great question. Now, two things. One, at the end of every year, as a custodian, we require clients to update their account values. Just because we provide something called a 5498 form, that is just showing the fair market value of an account. This does not need to be a certified valuation. So like with the real estate deal, right? If you invested $50, most likely it's going to be $50,000 for the first few years. So the clients can go into their online account and update it. Nothing's changed. It is, what was invested. The only other time we require clients to provide us a certified valuation is at the time they're taking a distribution out. When they're taking a distribution out, that means they're taking their money or assets sometimes from that tax advantage to their personal ownership. So no longer is it under your Madison Trust IRA. Now you're taking it to yourself. Again, we're going back to the vacation property. You know what? You're now retired. You would like your beach house, Keith. You want to take it out of your Madison Trust account to your personal name so you can just live by the beach, right? At that point, I'm going to need an appraisal because I'm going to have to do a certain bit of reporting to show that this distribution took place.
Right.
So
right. Okay.
It's either at the year end which you can do it online, doesn't need a certified valuation. Or if you do take a distribution out, we will need a certified valuation. So we report the 1099-R form accordingly. And of course, everyone can work with their CPA or financial professionals at the time of when they're filing their taxes.
Yeah. Okay. That makes sense. Let's see. I've got a few other questions for you, but maybe before we go there, Dana, if you could maybe just let everybody know how they can find out more about you, more about your company, and if they would like to get you on the phone and open up a self-directed IRA. How can they reach you?
Fantastic. So our site is madisontrust.com. And if you would like to learn more about what the services we provide or self-directed IRAs in general, definitely take a look at our site. We have fantastic client support teams on our site. You can set up a consultation call with any one of them. However, if you would like to, of course, speak with yours truly, that is me, feel free. My direct number is 845-400-8454. And I'm also found on our Madison Trust site. And I'm happy to get on the phone to discuss what you are trying to accomplish with your retirement plan and how we, Madison Trust, can help you get there.
Great. And before I've got two more questions for you that I ask every guest, but before I get to that, is there anything else that maybe we didn't cover that you feel like is important for the listeners to know?
Keith, you were pretty thorough. You put me on the spot. You were really good.
Thank you. All right. Well, I'll go ahead and ask the two questions. So one would be, if you were giving advice to somebody who's maybe just starting out their investment, their wealth building journey, what would that advice be?
Oh, that's a good question. I think my advice would be definitely sit down, do some research. Understand what the goal is you're trying to accomplish, because you need to have a goal in mind to figure out the plan to get to it. You can't just be like, you know what, I'm going to just do a self-directed IRA just because Dana told me to do so. We need to figure out what the goal is. So especially for the younger folks who are just getting started, figure out what you guys want to do. Do you want to have diversify? Do you want to own real estate property? Do you want to do figure that out, then do some research to figure out what works best for you. For some people, perhaps the stock market, stocks and bonds might be the best. For people who have sizable amount of retirement funds, diversifying might be the best option. And that's where self-directed IRAs comes in. But to figure all of that out, everyone needs to have a goal. How much would you like to retire with, right? Because we don't want to be working when we're 80, 90. At that point, we want to be comfortably retired. So figure that out, sit down, do some research, and that's when you want to call me. You want to call me and be like, this is what I want to do. What can we do to get to that point? And then Madison Trust is happy to help.
Awesome. And what about a book recommendation? A lot of times folks will have real estate books, but it doesn't have to be real estate by any means. Anything good that you've read recently? I asked for the audience, but I also asked for myself, Dana. So.
So that is funny. Well, this is a very famous book, Rich Dad, Poor Dad.
Mm-hmm.
Robert Kiyosaki, I believe.
Yes.
And I actually had the pleasure of meeting Mr. Kiyosaki at a conference earlier this year in Arizona. And
nice.
He's a wonderful. And it's funny because when I was back in Sri Lanka, I read this book in my teens. And when you're a teenager, that book doesn't make any sense. Like, what do you know, right?
That's right. No, that's very true.
Nothing makes sense, but it's so funny. So after I met him this year at this conference, I reread the book again. And it was just stunning how relevant that information is even right now. And I would always recommend that book to anybody, especially people trying to get into real estate and build wealth using real estate. Of course, times do change, but right now, everyone's trying to get into the real estate market. The bubble hasn't burst. It's still really booming. There is not a lot of supply out there, but the demand is always increasing. So for anyone who's starting off, I would definitely recommend Rich Dad Poor Dad.
Yeah, that's a great recommendation for sure. So, all right, Dana. Well, I've really appreciated our time together. I've enjoyed it. You've opened my eyes to just some things. I've made some notes on things I need to check with respect to my own to see if there's an ability to pull some stuff out. And if so, I know who I'll be calling, right?
So, Keith, you and I, we're gonna figure this out for you.
That's right. Exactly. All right. Well, thank you so much for being on the Wealth Flow.
Of course, and thank you for having me.
Absolutely.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.